Hey everyone, stick with us versus herd. If it's your first time here, like the content, hit subscribe. If you want to get notifications from when we post videos, tap the bell or go live for say. We go live Monday through Friday, 30 minutes before market open. And if you want to join the UVH fam, our community, link is below in the description to our Discord and our options trading group on Facebook. If you're here right now, say what up. Currently, S&Ps are down 550, Dow's down 29, NASDAQ down 22, gold's down 3. You know, we just kind of chilling pre-Fed, kind of seeing what's going on. What's going on, Rodney, Tom, Faiz? How we doing? Good morning. We're just getting it going. What's up, Jim? Definitely appreciate you guys tuning in this morning. Just getting it popping. Getting a lot of news out this morning. We're going to all right, this is what we're gonna do. Gonna go over some news here. We're gonna get some Fed stuff. We're gonna try to watch the Fed today. Gonna try to watch if I can get the live stream up from YouTube about the Fed. So I'm gonna try to find that. The Fed, Jay Powell's gonna be going live here, so I'm gonna try to get that going. Yo, Christina, how long does this run? Typically anywhere between 45 minutes to an hour. So we're gonna watch the Fed, Jay Powell speak. I got that on deck right here, YouTube. So real quick, while the runner, what's going on? If you're just joining, say what up. Brian, Rinjin, Jeff. All right, so. Couple things happened this morning before we get into Jay Powell. Jay Powell's going to be going live in just a couple minutes here, like 8 minutes, and we're going to watch it here live on the stream. The GDP down 31.7, not 3 point. We're in 2020. GDP is down 31.7% versus a 32.5% decline. Did beat expectations, but equally, I mean, we're talking about GDP being down 31%. So it's not good. It's not a good number. I mean, it's a good number that we didn't, you know, it's still bad. Still bad. Also, unemployment coming in just above 1 million. I think last week was 1.1 million, and last week marked the 22nd time in 23 weeks that initial claims were above 1 million. Yeah, I think DKNG, Jonathan. I got DKNG popped up on my radar here. So, it says continuing claims continue to drop, but still indicate a highly stressed labor market. Of course. So, that's kind of priced in right now, but this is kind of where we're at for unemployment claims. Still just chilling above 1 million. A couple of weeks ago, we had like 900 something thousand was declining, but now we're kind of, I think, looks like we're kind of flattening out around the 1 million jobs mark, which is, you know, pretty bad. But you know, not that you want to be bearish right now. Not that you want to be bearish, of course. Of course you don't want to be bearish, you know, because we got the Fed to save the day. The kind of what is expected right now. We're gonna watch, kind of see what Jay Powell says here, but he's saying, you know, the Fed's is expected to use the annual Jackson Hole Symposium to change the way it addresses inflation, and that's the big thing about what we're watching with Powell is what they're going to do about inflation and what they're going to do to battle inflation, because we have interest rates low. From what we understand, they're not going to try to raise interest rates to combat inflation. So we're going to see what he says here. That's the whole thing. So he's expected to discuss a policy allowing inflation to range on both sides of a target, letting it rise more than the Fed might normally do to keep the economy from being trapped in low growth. So I don't know if this is some sort of experiment that he's doing. He's like, hey, 2020 is bad enough. Let's run some experiments on the people. In 100 years, they're going to be reading about this if we effed up or if this was the best thing ever. Maybe it's what's for best. Maybe it's best. Maybe it's going to work out. maybe we'll all be broke and we're paying $20 for a loaf of bread. Who knows? But this is kind of the situation right now. Is my audio too high? Is it distorted? You guys good on my audio? Just checking in. I don't know. My kids come in here and mess with my setup, change the mic. I don't even know. It looks like it might be a little bit on the high side, so let me know. Yo, Samir, what's going on? If you're just joining, say what up. Another news. I'm just trying to run through the news real quick because I want to tune into Jay Powell. I'm gonna stream it. Hopefully, I don't get copyright flagged, but screw it. GOP is going to propose a smaller coronavirus stimulus bill as well. Republicans considering a narrow coronavirus relief bill. So we'll see. The House probably not going to agree to it. So, and at this point, the House may not agree to it until after the election, just to screw Trump. But not to be political, but that's the game we're in. Oh, my name Powell down 50 point. Oh my gosh, yeah. TikTok. Kevin Mayer left. He couldn't take the smoke. It was a little bit too much for him. Dude left his executive position at Disney to be the CEO of TikTok. Only 90 days later to leave. So that dude screwed up. Definitely should have stayed with Disney. Don't get involved with China and America right now. Do not do it. Learn from Kevin's mistake. Kevin's teaching, showing us that you don't want to do that. He messed his. He's still rich. He's still really, really rich. So he's going to be okay. But I don't think Disney is going to be hiring him back. On top of that, NBA shut down, boycotted last night. No games. Season may be in jeopardy. So stocks like DKNG, Penn, it's gonna DKNG already kind of ripping down here a little bit. Market's pushing up here. Market is S&Ps are just kind of trying to go green right now. Dow turned green ahead of the Fed. So let me see if we can get them lined up. You think? Let's see here. Gonna try to get this up. All right, he's here. Here he is. He's already on. He's already on. Hold on. Let me turn my mic off.
Today, I will discuss our review, the changes in the economy that motivated us to undertake it, and our revised statement, which encapsulates the main conclusions of the review. We began this public review in early 2019 to assess the monetary policy strategy, tools, and communications that would best
let me know if you guys can hear and audio is good.
Congressionally assigned goals of minimum employment and price stability over the years ahead in service to the American people. Because the economy is always evolving, the FOMC's strategy for achieving its goals, our policy framework, must adapt to meet the new challenges that arise. 40 years ago, the biggest problem our economy faced was high inflation. The great inflation demanded a clear focus on restoring the credibility of the FOMC's commitment to price stability. Chair Paul Volcker brought that focus to bear, and the Volcker disinflation, with the continuing stewardship of Alan Greenspan, led to the stabilization of inflation and inflation expectations in the 1990s at around 2%. The monetary policies of the Volcker era laid the foundation for a long period of economic stability known as the Great Moderation. This new era brought new challenges to the conduct of monetary policy. Before the Great Moderation, expansions typically ended in overheating and rising inflation. Since then, prior to the current pandemic-induced downturn, a series of historically long expansions had been more likely to end with episodes of financial instability, prompting essential efforts to substantially increase the strength and resilience of the financial system. By the early 2000s, many central banks around the world had adopted a monetary policy framework known as inflation targeting. Although the precise features of inflation targeting differed from country to country, the core framework always articulated an inflation goal, the primary objective of monetary policy. Inflation targeting was also associated with increased communication and transparency designed to clarify the central bank's policy intentions. This emphasis on transparency reflected what was then a new appreciation that policy is most effective when it is clearly understood by the public. Inflation targeting central banks generally do not focus solely on inflation. Those with flexible inflation targets take into account economic stabilization in addition to their inflation objective. Under Ben Bernanke's leadership, the Federal Reserve adopted many of the features associated with flexible inflation targeting. We made great advances in transparency and communications with the initiation of quarterly press conferences and a summary of economic projections, which comprises the individual economic forecasts of FOMC participants. During that time, then Board Vice Chair Janet Yellen led an effort on behalf of the FOMC to codify the committee's approach to monetary policy. In January 2012, the committee issued its first statement on longer-run goals and monetary policy strategy, which we often refer to as the consensus statement. A central part of this statement was the articulation of a longer-run inflation goal of 2%. Because the structure of the labor market is strongly influenced by non-monetary factors that can change over time, the committee did not set a numerical objective for maximum employment. However, the statement affirmed the committee's commitment to fulfilling both its congressionally mandated goals. The 2012 statement was a significant milestone, reflecting lessons learned from fighting high inflation, as well as from experience around the world with flexible inflation targeting. The statement largely articulated the framework the committee had been following for some time. The completion of the original consensus statement in January 2012 occurred early on in the recovery from the global financial crisis, when notions of what the new normal might bring were quite uncertain. Since then, our understanding of the economy has evolved in ways that are central to monetary policy. Of course, the conduct of monetary policy has also evolved. A key purpose of our review has been to take stock of the lessons learned over this period and identify any further changes in our monetary policy framework that could enhance our ability to achieve our maximum employment and price stability goals in the years ahead. Our evolving understanding of 4 key economic developments motivated our review. First, assessments of the potential or longer-run growth rate of the economy have declined. For example, since January 2012, the median estimate of potential growth from FOMC participants has fallen from 2.5% to 1.8%. Some slowing in growth relative to earlier decades was to be expected, reflecting slowing population growth and the aging of the population. More troubling has been the decline in productivity growth, which is the primary driver of improving living standards over time. Second, the general level of interest rates has fallen both here in the United States and around the world. Estimates of the neutral federal funds rate, which is the rate consistent with the economy operating at full strength and with stable inflation, have fallen substantially, in large part reflecting a fall in the equilibrium real interest rate, or R star. This rate is not affected by monetary policy, but is instead driven by fundamental factors in the economy, including demographics and productivity growth, the same factors that drive potential economic growth. The median estimate from FOMC participants of the neutral funds rate has fallen by nearly half since early 2012, from 4.25% to 2.5%. This decline in assessment of the neutral federal funds rate has profound implications for monetary policy. With interest rates generally running closer to their effective lower bound, even in good times, the Fed has less scope to support the economy during an economic downturn by simply cutting the federal funds rate. The result can be worse economic outcomes in terms of both employment and price stability, with the costs of such outcomes likely falling hardest on those least able to bear. Third, and on a happier note, the record-long expansion that ended earlier this year led to the best labor market we had seen in some time. The unemployment rate hovered near 50-year lows for roughly 2 years, well below most estimates of its sustainable level. And the unemployment rate captures only part of the story. Having declined significantly in the 5 years following the crisis, the labor force participation rate flattened out and began rising, even though the aging of the population suggests it would keep falling. For individuals in their prime working years, the participation rate fully retraced its post-crisis decline, defying earlier assessments that the global financial crisis might cause permanent structural damage to the labor market. Moreover, as the long expansion continued, the gains began to be shared more widely across society. The Black and Hispanic unemployment rates reached record lows, and the differentials between these rates and the white unemployment rate narrowed to their lowest levels on record. As we heard repeatedly in our Fed Listens events, the robust job market was delivering life-changing gains for many individuals, families, and communities, particularly at the lower end of the income spectrum. In addition, many who had been left behind for too long were finding jobs, benefiting their families and communities, and increasing the productive capacity of our economy. Before the pandemic, there was every reason to expect that these gains would continue. It is hard to overstate the benefits of a strong labor market, a key national goal that will require a range of policies in addition to supportive monetary policy. Fourth, the historically strong labor market did not trigger a significant rise in inflation. Over the years, forecasts from FOMC participants and private sector analysts routinely showed a return to 2% inflation, but these forecasts were never realized on a sustained basis. Inflation forecasts are typically predicated on the natural rate of unemployment, or U star, and of how much upward pressure on inflation arises when the unemployment rate falls relative to U star. As the unemployment rate moved lower and inflation remained muted, estimates of U star were revised down. For example, the median estimate from FOMC participants declined from 5.5% in 2012 to 4.1% at present. The muted responsiveness of inflation to labor market tightness, which we refer to as the flattening of the Phillips curve, also contributed to low inflation outcomes. In addition, longer-term inflation expectations, which we have long seen as an important driver of actual inflation, and global disinflationary pressures may have been holding down inflation more than was generally anticipated. Other economies have also struggled to achieve their inflation goals in recent decades. The persistent undershoot of inflation from our 2% longer-run objective is a cause for concern. Many find it counterintuitive that the Fed would want to push inflation up. After all, low and stable inflation is essential for a well-functioning economy. And we are certainly mindful that higher prices for essential items, such as food, gasoline, and shelter, add to the burdens faced by many families, especially those struggling with less jobs and incomes. However, inflation that is persistently too low can pose serious risk to the economy. Inflation that runs below its desired level can lead to an unwelcome fall in longer-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. This dynamic is a problem because expected inflation feeds directly into the general level of interest rates. Well-anchored inflation expectations are critical for giving the Fed the latitude to support employment when necessary without destabilizing inflation. But if inflation expectations fall below our 2% objective, interest rates would decline in tandem. In turn, we would have less scope to cut interest rates to boost employment during an economic downturn, further diminishing our capacity to stabilize the economy through cutting interest rates. We have seen this adverse dynamic play out in other major economies around the world and have learned that once it sets in, it can be very difficult to overcome. We want to do what we can to prevent such a dynamic from happening here. We began our review with these changes to the economy in mind. The review had 3 pillars: a series of Fed Listens events held around the country, a flagship research conference, and a series of committee discussions supported by rigorous staff analysis. As is appropriate in our democratic society, we have sought extensive engagement with the public throughout the review, The Fed Listens events built on a long-standing practice around the Federal Reserve System of engaging with community groups. The 15 events involved a wide range of participants: workforce development groups, union members, small business owners, residents of low and moderate income communities, retirees, and others, to hear about how our policies affect people's daily lives and livelihoods. The stories we heard at Fed Listens became a potent vehicle for us to connect with the people and communities that our policies are intended to benefit. One of the clear messages we heard was that the strong labor market that prevailed before the pandemic was generating employment opportunities for many Americans who in the past had not found jobs readily available. A clear takeaway from these events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. The research conference brought together some of the world's leading academic experts to address topics central to our review, and the presentations and robust discussion we engaged in were an important input to our review process. Finally, the committee explored the range of issues that were brought to light during the course of review in 5 consecutive meetings beginning in July 2019. Analytical staff work put together by teams across the Federal Reserve System provided essential background for each of the committee's discussions. Our plans to conclude the review earlier this year were, like so many things, delayed by the arrival of the pandemic. When we resumed our discussions last month, we turned our attention to distilling the most important lessons of the review in a revised statement on longer-run goals and monetary policy strategy. The federated structure of the Federal Reserve, reflected in the FOMC, ensures that we always have a diverse range of perspectives on monetary policy, and that is certainly the case today. Nonetheless, I am pleased to say that the revised consensus statement was adopted today with the unanimous support of committee participants. Our new consensus statement, like its predecessor, explains how we interpret the mandate Congress has given us and describes the broad framework that we believe will best promote our maximum employment and price stability goals. Before addressing the key changes in our statement, let me highlight some areas of continuity. We continue to believe that specifying a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. The significant shifts in estimates of the natural rate of unemployment over the past decade reinforce this point. In addition, we have not changed our view that a longer-run inflation rate of 2% is most consistent with our mandate to promote both maximum employment and price stability. Finally, we continue to believe that monetary policy must be forward-looking, taking into account the expectations of households and businesses and the lags in monetary policy's effect on the economy. Thus, our policy actions continue to depend on the economic outlook as well as the risks to the outlook, including potential risks to the financial system that could of our goals. The key innovations in our new consensus statement reflect the changes in the economy I described. Our new statement explicitly acknowledges the challenge posed by the proximity of interest rates to the effective lower bound. By reducing our scope to support the economy by cutting interest rates, the lower bound increases downward risks to employment and inflation. To counter these risks, we are prepared to use our full range of tools to support the economy. With regard to the employment side of our mandate, our revised statement emphasizes that maximum employment is a broad-based and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for many in low and moderate income communities. In addition, our revised statement says that our policy decision will be informed by our assessments of the shortfalls of employment from its maximum level, rather than by deviations from its maximum level, as in our previous statement. This change may appear subtle, but it reflects our view that a robust job market can be sustained without causing an outbreak of inflation. In earlier decades, when the Phillips curve was steeper, inflation tended to rise noticeably in response to a strengthening labor market. It was sometimes appropriate for that to tighten monetary policy as employment rose toward its estimated maximum level in order to stave off an unwelcome rise in inflation. The change to shortfalls clarifies that going forward, employment can run at or above time estimates of its maximum level without causing concern, unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. Of course, when employment is below its maximum level, as is so clearly the case now, we will actively seek to minimize that shortfall by using our tools to support economic growth and job creation. We have also made important changes with regard to the price stability side of our mandate. Our longer run goal continues to be an inflation rate of 2%. Our statement emphasizes that our actions to achieve both sides of our dual mandate will be most effective if longer-term inflation expectations remain well anchored at 2%. However, if inflation runs below 2% following economic downturns, but never moves above 2% even when the economy is strong, then, over time, inflation will average less than 2%. Households and businesses will come to expect this result, meaning that inflation expectations would tend to move below our inflation goal and pull realized inflation down. To prevent this outcome and the adverse dynamics that could ensue, our new statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. Our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. Of course, if excessive inflationary pressures were to build, or inflation expectations were to ratchet above levels consistent with our goal, we would not hesitate to act. The revisions to our statement add up to a robust updating of our monetary policy framework. To an extent, these revisions reflect the way we have been conducting policy in recent years. At the same time, however, there are some important new features. Overall, our new statement on longer-run goals and monetary policy strategy conveys our continued strong commitment to achieving our goals, given the difficult challenges presented by the proximity of interest rates to the effective lower bound. In conducting monetary policy, we will remain highly focused on fostering as strong a labor market as possible for the benefit of all Americans. And we will steadfastly seek to achieve a 2% inflation rate over time. Our review has provided a platform for productive discussion and engagement with the public we serve. The Fed Listens events helped us connect with our core constituency, the American people, and hear directly how their everyday lives are affected by policies. We believe that conducting a review at regular intervals is a good institutional practice, providing valuable feedback and enhancing transparency and accountability. And with the ever-changing economy, future reviews will allow us to take a step back, reflect on what we've learned, and adapt our practices as we strive to achieve our dual mandate goals. As our statement indicates, we plan to undertake a thorough public review of our monetary policy strategy, tools, and communication practices roughly every 5 years. Thank you very much.
And thank you, Chair Powell, for your remarks and also for...
All right. Our friend, let's see, the market's about to open here. S&Ps ran up, pulling back already, hit 34.91 on ES. Qs ran up to 293. So basically what Mr. Powell's saying, market just opened, guys. Let's see what it does here. Basically let's see what VXX is doing here. VXX popping down a little bit. We'll see. So basically what Mr. Powell is saying is that, I had an article here. So basically they're going to take the hands-off approach. They're not going to raise rates, which was causing the market to run up. So like, okay, we're not going to raise rates. They want to sustain the labor market, and they're trying to keep inflation around 2%. However, they did say they're going to use whatever tools are at their disposal to support the market, the economy. Means they're going to pump it. Means for the foreseeable future, probably until we're middle-aged men and women. Probably going to we're probably going to see that the markets are going to be fake and they're going to be pumping it. And, you know, the numbers are bad. I mean, the numbers this morning, I mean, we got GDP. We had GDP down 31.7%. I mean, we're like, this is like depression level. This is like depression level events here. You know what I mean? Like, it's bad. It's bad. So we have depression level things going on right now. GDP, unemployment is bad, inflation they don't care about. They're going to try to keep it in check, but they're not going to do anything about it. So basically they're just going to let things run its course and hope for the best, guys. And if things get bad for the market, they'll step in and do what they need to do. But you know, the stock market is not necessarily the economy. So, you know, he did say they're trying to try to sustain the labor market. So it's going to be interesting how they do that. It's going to be interesting. So he didn't say like, yeah, we're going to pump in $10 trillion over the next 2 years. He didn't say that, but he said that they're going to use all the tools at their disposal to do whatever they need to do. So rates are going to be low. Inflation's going to go up. Stocks are going to go up. That's what that means. That's what that means. So, you know, I don't know. I don't know what the future holds. The Fed, I mean, honestly, it's interesting to me that the Fed is going to take an approach where it's just like, okay, we're just going to step back, see what happens. If something bad happens, we'll step in. But let's just run its course. Either they don't know what they're doing, or they don't know because we've never been in this situation before, and they just don't know. And they're like, well, we need more data. Like kind of like for me, if I'm confused about the market, what I do is like, okay, I'm gonna step back. I need more data to understand what's happening here. I need to understand what is going on. So I'm not gonna make a decision about my trades, about the market. I'm going to let the market do its thing. And that's kind of what it sounds like. It's like, hey, we need more data because I think that we're kind of screwed right now, but we don't know how screwed we are. So we're going to see what happens. That's kind of what it made it seem to me. I'm going to try to close out some trades here. Yeah, I mean, you know, I sold some premium at Abercrombie. I have some VXX calls, so I mean, I went in real light. For this. I mean, right now I'm just kind of chilling. Abercrombie's up like $1. VXX coming down a little bit. Calls are getting the premium, even though it's a little bit higher, premium is getting smashed a little bit. So we'll see what happens. But VXX trying to push up. Qs are coming down a little bit. SPY's coming down a little bit. Dow's still green, but we'll see. But S&P, NASDAQ turned red. So, got to see what happens. Airlines are making moves. Yeah, Boeing is up. Airlines are up. Delta. United. They have access to more economic data than anyone in the world. They have to sit back at some point just to reevaluate. Jathan, I agree. I agree with you. And I think, you know, now is probably a good time to kind of, because right now there's really not much pressure from the Fed because stocks are going up. I don't know if you want to call it a recovery of the economy, but there's no, like when stocks are just going straight down, there's a lot of pressure for the Fed, for the president, for any politician to do something. Like, the people are all down here like, help, help, help. And that's why they pushed the stimulus bill so quick. But now you notice that since the fires are put out, Fed is moving slow. The next round of stimulus checks or stimulus bill is not being pushed through because why? There's no urgency. There's no urgency to do so. Even though there's millions of people unemployed, they put the fire out that the public was demanding because why? The stock market was going straight down. People's 401ks were going down the toilet. I mean, Trump saw the entire gains from his presidency wiped out in like 6 to 8 weeks. So now that we got all that back and then some were hit all-time highs, they're kind of like, well, let's just kind of see what happens, which makes sense. So I want to see if they're going to change their tone, if they're going to change things around. Right now, the markets are a little bit undecided what they want to do. I mean, relatively flat, reddish, greenish. We have some stocks doing okay, but nothing. I mean, Apple's up $3 right now, but nothing really. Man, Beyond Push 8 is up $8. Beyond have news? What's up? Beyond Meat introduces a whole new day to shop Beyond e-commerce site. So Beyond launched an e-commerce site. Should have accumulated some in the 120. I was checking out Beyond, but I'm like, I don't know when it's going to move again. Beyond was chilling nicely right here in the 120, 125 range. We'll see what happens. We'll keep an eye on it. But that was definitely probably undervalued on these calls. Yeah, these calls are up 1,000% today on Beyond. It's pretty nice. Pretty nice. Anyone here? Anyone here holding Beyond? Nice consolidation. Facebook is getting hit though pretty hard. Facebook right now down 6. I mean, still up relatively high after yesterday's push, but now we'll kind of see what happens. So I might have to close out Abercrombie in a couple pieces here. Try to close some stuff out. NVIDIA credit spread working. Yeah. Now VXX pushing up. VXX is pushing up pretty high right now. It's coming back up to 25. So this is definitely some interesting price action right now. We got in the Qs popping down, but not really. We're not going to go anywhere. Boeing. Anyone trading Boeing right now? Did any coronavirus news come out? I didn't see any coronavirus news that's pushing the airlines. Did anybody see anything? I'm trying to find something. Hurricane Laura made landfall last night. Saw that, but what's pushing the airlines right now? Banks are doing well too. JP Morgan pushing up over 100 again after selling off pretty hard. Banks are pushing up. Bank of America is pushing up 1%. Goldman Sachs not really doing a whole lot, but it could be a laggard. Could push up to 210. Dollar Tree? I didn't trade Dollar Tree. What do you guys trade? Do you guys trade earnings on Dollar Tree and Dollar General? Not only travel's up. CW. NAO was slammed. And today is definitely going to be a tricky day. I might just take off today and be like, chill, kind of relax, chill out a little bit. But yeah, Dollar Tree, man, they got hurt. I mean, but they came down to 100. They're at currently 100 right now. Not too bad. I don't know what they expect to move with it. I didn't trade Dollar Tree because I felt like I didn't trade Dollar Tree or Dollar General because I felt like it could push up relatively high. And after getting squeezed on CRM, Michelle's in BA right now. No one traded. SPY right now is 347. SPY's right here. So I don't know if today's gonna be a busy day or what. What's the plan? We gonna have a red day today, or are we gonna have a green day? Dow's pushing up green, but Nasdaq is getting hit pretty hard. Are we gonna see a rotation in the markets? Kind of an outflow of tech. Tesla's pushing up 2,200. NIO, NIO is down 6%. Oof. What's DKNG right now with the sports news? DKNG actually is holding up. I mean, it's down to almost 3%, but it's holding. I think maybe I'll close out. Maybe I'll close out my VXX calls and reload. Close out my VXX calls. Up 30% on them. What do you guys think? Close it out. Don't close it out. Let's see here. I think we close it out. I think we close it out and reload. All right, we closed out VXX. Let's see what happens here. Yeah, because VXX coming down a little bit. Close and reload. Take profits, redeploy capital. That's it. That's it. So that's the motto. All right, so I took profits. VXX, made 30%. Not amazing, but I'm a little bit concerned. We're gonna get a little squeeze here. I mean, Dow's up over 100 points right now. S&Ps are green. Nasdaq is down 28. So we'll see. Again, I kind of have to get some more information here. You bought NKLA, man. I haven't looked at that stock in a minute. It's kind of an ugly chart on the 1 year here. Could definitely drift lower. But if EV pushes up, I mean, what are you guys trading Workhorse? Workhorse, I mean, looks pretty nice in here in this consolidation. Did you close ANF? No, I did not. Did not close it out. Yeah, who would have thought that Abercrombie was going to push up like that? I mean, I'm down like $100 on it, so it's not like a huge deal. But who would have thought that they're gonna do that well on earnings? I mean, but it's right. It's up 14%. It's right at the expected move right now. So we'll see if there's some sellers in here. So I sold some premium here, but we'll see if it gets rejected here at the 200-day. Kind of chill. I could try to close it out. We'll see. I don't know. We'll see what happens. Yeah, VXX pushing down now. So, the thing with Powell is he didn't have any surprises. That it was pretty much what was expected, because we've been talking about this a couple of days. What he was going to say about inflation, it was pretty much expected. And in regards to the stock market, he's saying that he's going to support the stock market no matter what happens. So probably people are just going to buy. We're just going to buy, go straight up. Buy some stock for the grandkids. Inflation will be out of control, but it's all good as long as stocks go up. We got kind of slow. Alibaba. Anyone trading Alibaba? Alibaba's down $4. We do have coming up on Monday. We have Zoom earnings. We have Zoom earnings on Monday. And then on Thursday, we have Lululemon and DocuSign, also Broadcom earnings. So pretty slow week in terms of earnings here. So hopefully we get some volatility in, because earnings trades definitely drying up. So we'll see what happens. Looks like the market's a little bit undecided today, you know? Did you make that earnings calendar? We did. We did make it. Yeah, what we did with the earnings calendars, because there's so many companies that we boil it down to the only ones that we really matter as options traders. You know, so that's why our calendar is a lot less companies, but they're the companies that matter to options traders. So everything that we do is geared towards the options trader. Well, we're gonna get a dump here. Watch VXX run to 27. I just sold, but I mean, I'm happy about 30%. I'm happy about that. I'm not angry about 30%, but yeah, you can go to it's part of the impact report, so you can go to usversusherd.com. Check it out. Looking like we might be in a little bit of trouble here. See what the Qs are doing. So S&P's pushing down a little bit. I mean, we're kind of flat though, so it could definitely go either way. But the price action not looking great. VXX ramping up. We had an amazing ramp up yesterday on VXX when I bought those contracts. And I bought them around like 23.90 area. VXX ramped up all afternoon. But right now it's kind of getting stuck. I'm a little bit concerned about the 25 area, because around 25 is when VXX has been dropping. So that's why I wanted to kind of take some profits, because I thought maybe there was a potential we can gap up today. You know, I had the contracts I had were expiring like 25 days away, so it wasn't I wasn't pressured to sell them. But I know around 25 we've been getting, VXX has been coming down after 25. We tapped above 25 yesterday and pushed down. So losers rallying today. Yeah, Qs are getting smashed right now. But it's like now you don't want to short anything like ever, knowing that the Fed is going to support the stock market for indefinitely, which I mean they have been for a while. But RKT, yeah, that is, man, that hit $32 the other day. Jeez. It's crazy. So does RKT, DKNG's back at 38, so that's interesting. I mean, I kind of, like DKNG, I kind of would want to go short around like the 38.40, because this is kind of where it's been getting rejected, but, it's showing some pretty good strength on a day when the NBA is boycotting. But if the NBA cancels the rest of the season, I mean, I think that, because I mean, what do you think is going to happen to football? I mean, football is supposed to is football starting up, or football is not starting up? I don't know. Does anybody have any information on football? I think it's supposed to start up, but are the players going to boycott it like the NBA? Now I know the NFL is a little bit more wild. Only got prayers for football. Yeah, I mean, I think football. If NBA is canceled, I mean, I think it's gonna be interesting. So I'm not bearish on DKNG, but if there's no sports, I mean, what are people supposed to do? Bet on esports? Bet on the Fortnite? Bet on Call of Duty? I would do that. I'd bet on Call of Duty. No, I'm not. I don't currently have an options position on DKNG. It's just kind of interesting. It's just kind of interesting. The price action that we're seeing right now. Esports and Netflix. But yeah, we're chilling. I mean, that VXX is chilling, SPY is chilling. All right, what do you guys think are the odds of an Amazon stock split? Mel, what's up? What are the odds of an Amazon stock split? You think they're going to be having pressure? Or you think they're going to say, we kind of beat to the tune of our own drum. We don't care about Apple or Tesla. We're just going to keep grinding. Yeah, they did one I think 1999. You get a 95% chance. You think a 95%? So you're saying for Amazon, we should be buying any dip possible. But I'm worried that the stock split may never come. Last time was 20 years ago. The chart's still good for a buy the dip. Amazon all the dips, but the dips are pretty harsh. I do think it could come back down to 3,300 though. I do think it could. Will it? I don't know. It's very difficult to price a company's stock right now. You know what I mean? You don't know. Not talking about options trading, but as an investor, if you're holding shares in companies, you're like, man, is this company worth this much or not? Should I sell my stock? Should I keep my stock? Are we going to crash? Are we going to keep growing up? You know what I mean? It's crazy. It's crazy. But here's the question for you. Would you prefer to buy Apple stock or Amazon stock? Now, I know they're different sectors, different industries and all that. Would you rather have Apple stock or Amazon stock? Amazon doesn't even pay a dividend. Yeah, we're the market's on some right now. We're flipping red to green, red to green, red to green. It's they don't know what they're going to do. You guys don't think Apple will have a disruptor in the future with the lack of innovation? I'm just saying. You guys think there's going to be a disruptor? Microsoft made it through. They made it through with Windows 10, Office 365. They pushed. Microsoft was looking real suspect for a while, but then they pushed through without Bill Gates. Unless they still got Bill Gates on I'm sure they still talk to Bill Gates, but Apple has big ties to China. Yeah, because that's where they all make their products. All right, so now the market is definitely trying to push up, but I don't know. I don't think I want to be a buyer just right now. I think that we need more data. You can catch some momentum stocks. Boeing's up $8. It's back up. But if you look at the 1 year, it still looks like garbage on the 1 year. Definitely some heavy resistance on Boeing. Do we have another short opportunity? Microsoft. Let's check out Microsoft. Microsoft's up 7. Jeez. TikTok sale to Microsoft could come in the next 48 hours. That's interesting to see. The CEO of TikTok would leave before the sale. Because wouldn't he get some sort of golden parachute or something, even though he's only been on the job 90 days? Or they said, hey, we want to buy this, but we don't want him. We want everybody but him. What's the deal? Got it. Microsoft buying TikTok. All that data they'll be collecting. It's okay to collect the data, guys, as long as it doesn't go to China. Just be honest. Just be honest. The White House wants the data. They just don't want China to have it. It's okay to collect it. They don't care about privacy. They don't care about security. It's okay to collect the data as long as it's being stored in the U.S. data center. It's all good. And then they can call up probably part of the deal. That's the whole thing with Apple's the back doors. Apple, prides themselves on security, encryption, and they don't let the FBI and the people tell them what to do to access the phones. The government doesn't like that. So maybe there's something in the deal with the White House, because the White House was all over this. And I'm really interested to see what the government is going to get out of this deal, because one of Trump's stipulations, which I don't think he could have any, one of his stipulations was that they were going to get a piece of the sale was going to go to the Treasury. I don't know. So, yeah, Microsoft probably want to watch, but now let's see here. Microsoft, ever since they cleared that, I mean, this is unlike Microsoft to ramp up this much, and obviously there's news here, but crazy. Over that, everything's kind of moving relatively slow. I mean, Facebook is down. What's Twitter and Snap? Twitter's dropping. Snap is dropping, so they're probably dropping due to the competitor being, Facebook and all that were probably ripping because there was a chance that if TikTok was banned or boycotted or whatever from the US, then that's one less competitor. But if Microsoft buys them, or if it was Oracle or another company buys them, then that competitor still exists, which is interesting. JP Morgan ripping. JP Morgan ripped to 102. Bank of America ripping as well. Yeah, banks are hot today. What's our boy Home Depot doing? Home Depot hit 293. It's falling like a rock. You gotta ride the waves, and the thing is with this market, what I've been noticing is you just kind of hop on board, ride the waves, and learn to get off. Don't get attached to your position. Learn to get off. So we'll see what happens here, guys. I don't know. I'm not gonna put any trades on right now. I'm just gonna kind of watch the market, see what happens. I'm gonna run though. Nice hanging out with you guys this morning. Join the Discord, join the Facebook group. We'll be around. Hit it and quit it. You got it, man. So stay safe, stay green. It's us versus herd.